You betcha. So, yeah, we did a segment back in May on the Canadian banks beginning to extend mortgage amortization periods on outstanding mortgages to help ease the pain of some Canadians facing higher interest rates and ongoing inflationary pressures. So, now that the banks have reported their Q3 2023 results, I guess a couple weeks ago, I thought that I would go over some common themes we saw with the banks' results. And of course, like Ryan was just saying, see what their mortgages by remaining amortization looks like now. So, just quickly on the actual results, several of the banks failed to meet analyst expectations, and only RBC actually outperformed the expectations. And just some of the common themes which they reported here were there was growth in GIC funding as investors flock to higher interest bearing securities. There were comments that there was a bit of a slowdown in deal making and mortgages as consumers are more cautious with elevated rates. And a few cited fierce competition for mortgage spreads right now. A couple of banks also discussed reducing headcount, specifically RBC as well as TD. And for TD, they indicated that they had, a few large one-time costs due to the failed acquisition of First Horizon Corp. And lastly, this is probably the biggest takeaway. Every bank reported higher provisions for credit losses. So I have up on the screen here just a few for an example, like BMO. Their provision for credit losses this year was $492 million compared to the same quarter last year, which was about $136 million here. Um, you know, Also just a note to keep in mind, these aren't actual credit losses that the banks have experienced, but it's just that the banks are placing aside more provisions for potential losses in the future. So we'll see kind of how that works out going forward. And I also wanted to show here that some earnings estimates from analysts and that they've been downgrading their EPS estimates as the banks are facing a tougher macroeconomic environment. So we've seen revisions kind of across the board here. Now, actually moving to the bank's mortgages by remaining amortization, just as a reminder, in 2021, there were basically no mortgages with an amortization period of greater than 35 years. Now, almost a third of all mortgages in Canada are over, that 30-year amortization. So first, I've got TD up on the screen here. Now they have about 48% of its mortgages with a greater than 25-year amortization, as we ended up seeing an uptick in the 25 to 30-year mortgages and a slight move downward in mortgages greater than 35 years. Now, this is also a similar story with CIBC. 47% of all mortgages have an amortization period greater than 25 years, which was pushed up by growth in the 25 to 30-year mortgages and was again offset by a slight decline in mortgages greater than 35 years. And RBC, lastly, 43% of their mortgages have an amortization of greater than 25 years. And again, there was a slight increase in 25 to 30-year mortgages with a slight decrease in mortgages over 35 years. So I also wanted to bring this up. The Financial Consumer Agency of Canada, or FCAC, we'll call them, said 2/3 of mortgage holders in Canada are having trouble meeting their financial commitments. So in July, the FCAC provided new guidelines for banks on how to deal with at-risk consumers dealing with financial stress, with the aim of standardizing how lenders implement policies and procedures. And some of these items include waiving prepayment penalties, waiving internal fees and costs, not charging interest on interest, and then, of course, extending amortization periods. Now, banks and other lenders will sometimes offer various forms of relief for consumers struggling in these scenarios, so it's not a new thing. But again, the FCAC's new guidelines seek to standardize the approach, but do not actually prescribe direct action that institutions should take. So it's interesting that the Canadian Watchdog is, trying to place these guidelines in just to make sure that we don't have a runaway situation with amortization increasing. Now, I also wanted to show here, just because, I'm in the market for a house one day. Obviously, I'm getting priced out. But I wanted to show Canadian urban housing starts in the last month here. And I actually have it over the last few years. So the standalone monthly seasonal adjusted annual rate of total housing starts for all areas in Canada in July was down about 10% from June. And keep in mind, June was the strongest month so far this year. So we are coming off of a high sequentially. But despite the monthly drop, total housing starts for all areas in Canada was about 7% above the 5-year average. So, I've been seeing a lot of news articles talking about housing starts being very slow. But, if we're looking from a historical perspective, they actually remain pretty robust here. And lastly, I just wanted to finish on the affordability of housing in Canada, where the median resident in both Toronto and Vancouver are paying above 80% of their median income on their mortgage payment. And we can also look at Canada. It remains at approximately 60% across the country. And then when we look at Montreal and Calgary, they come in at better levels of around 40%. So, it's just going to be interesting to see what we see with the housing market over the next couple of years here. I mean, you'll continue to see me do segments. Hopefully, you continue to enjoy them. But yeah, now I'll just kind of open it up to the gentlemen and see if they have any thoughts or comments.
Interesting chart on affordability. So when we look back, affordability in Vancouver was almost as expensive or almost as bad in the 1980s and 1990s. And in both cases, that seemed to be right timed in line with a recession.
Yeah, that is true.
Yeah, and I think the really quite an eye-opening stat is 2/3 of mortgage holders are having trouble meeting their financial commitments.
Yeah.
I mean, it's not a third, which is still a lot.
Yeah.
Like 2/3, 67% are having trouble meeting their. I mean, it shouldn't be totally shocking given what's gone on, but you see it plainly in front of you, and I'm not sure how we can't have some kind of a recession coming up if 2/3, like 2 out of 3 people are having trouble meeting their financial commitments, and they have mortgages, right?
And I just popped like TD back up on the screen here. So in 2021, right? Am I looking? Yes, October 31st of 2021, 28% of their mortgages were greater than 25 years. We are now at, what did I write in my piece? It's 46%, I believe, or, 47% at CIBC. TD is now 48% of all mortgages are greater than 25-year amortization. So it's just crazy.
Basically half,
yeah, exactly. So it's just crazy to see. And this is something that we'll continue to track, and I'll continue to update my
those mortgages had to be extended clearly, or else the people were not able to afford the mortgage. I mean, that's totally what's going on essentially. Yeah,
totally.
I still think it's pretty much underreported.
Yeah, I agree.
Brennan's the only one who's ever reported it.
Well, when I was initially writing my piece, I was kind of like tooting my own horn, where it's like, oh, finally, there's some news articles that are actually really coming out about it. But yeah, we were ahead of the curve. Yeah.
And if anyone's wondering why the US hasn't popped up, because there is quite a big difference, they haven't really moved.
Yeah.
They use a standard 30-year fixed. They don't really do variable mortgages there. So they're a lot less interest rate sensitive compared to Canada. Yeah. So it's just
we were going through that. It was it's crazy how different it is when you're locked in at 3% for 30 years. Like it's ours, we're locked in for. Some people did 2 years, 3 years, 5 years would be on the longer end for Canadians. A lot do 5, but that's can be on the longer end, right?
And you made the comment too the one time where it's like, no doubt in 2008, the Canadian banks did so much better because, again, the consumers are taking on the interest rate risk more, I guess. So it didn't, or it reverted for Canadians paying lower rates.